inflation for November up by 66 basis points from 14.23% to 14.89%. Food inflation has now crossed the 18% Rubicon, driven by a lot of factors that we're going to get into. But most importantly, what does this mean for the average Nigerian? You're looking at average Nigerians right now as they're pricing goods and services. What does it also mean for the central bank in terms of their mandate for 2021? We're joined now by the head of research at Financial Derivatives Company Ltd, Damilola Akingbami, to answer these pressing questions. Damilola, good morning to you. Thank you so much for joining us. First of all, what do you make of these latest inflation figures? Did you folks over at FDC expect an increase?
Good morning, Rotus. Yes, we expected an increase. Our forecast was actually 14.8%. So the actual numbers were about 0.09% higher than what we projected. And the factors that drove this increase are the usual suspects. So there's the cost push factor. So we know about the forex rationing, which has really affected manufacturers and has led to imported inflation increasing. We also know, obviously, about the currency devaluation, which has also led to an increase in imported inflation because of the country's high import dependence. And also, if you look at supply shocks, the supply shocks have increased. Logistics and distribution costs have increased. We know the petrol pump price was increased towards the end of October, and the effect was felt in November. We know also of the electricity tariff increase. So all these factors have contributed to the increase in inflation rate. And these factors are still going to be prominent even towards the end of the year. Right now, the average year to date, January to November, is about 12.96%. That is way above the CBN's year-end projection of about 12.15%. And if you even compare that to last year's average, this time last year, the average was about 11.1%, and then 2018 was about 12.1%. So this year, definitely the inflationary pressures have heightened, and we're projected that inflation is going to close the year above 15%.
Gosh. So, Dami, I mean, with that kind of projection, what does this mean for investment returns for Nigerians?
Yes, so right now, the real returns on investment are negative. They've been negative since June this year, when the inflation rate was about 12.56% and the MPR was 12.5%. And if you go compare it to the Treasury bill rates, that means they've been having negative real returns for even way longer. So definitely this is going to continue, especially like I mentioned earlier, that the inflationary pressures are still prominent and are going to continue to increase even towards early next year into mid of next year. So that means the real returns on investment are going to remain negative, especially if the current accommodative stance of the CBN is still in place. And if you look at what our peers are actually going through right now, if you take 4 countries, South Africa, Ghana, Angola, and Kenya, out of these 4 countries, 3 of them have positive real returns on investment, apart from Angola, whose inflation rate is about 24.9% and its MPR is at 15.5%. Bear in mind that South Africa's inflation rate is within the South African Reserve Bank's target of 3 to 5%, and its interest rate is about 5%. So these are our peers. Angola, well, we could say that Angola being an oil-dependent country, just like Nigeria, is also experiencing what we're experiencing. But bear in mind, Angola has been in a recession even before now. It's been in a recession since about 2016. So these negative real returns are going to persist as long as the inflation rate policy is still accommodative and inflationary pressures continue to rise.
Thanks for that, Dami. It's not encouraging, but that's the reality. What about wages? I really want for folks to talk more about this, Dami. They don't seem to be. Well, not that they don't seem, they aren't moving fast enough to keep up with inflation. So are working Nigerians essentially stuck?
So the purchasing power of consumers obviously has been eroded because of the high inflation rate. And like you rightly said, wages are not increasing as fast as inflation is increasing. And aside from even the increase in the prices of consumer goods, bear in mind that the currency has been devalued at least twice this year. So typically everyone is experiencing a decline in real wages by the time you factor in the exchange rate adjustment, now coupled with rising prices. So definitely wages are going to continue to be the wage increase is definitely not going to be at par with the increase in inflation. And right now, the consumer is facing so many challenges, from low wages to even those that have been laid off. So the consumer is struggling. The consumer is facing higher electricity tariffs. The consumer is facing increase in petrol prices. So unemployment levels are increasing. Poverty levels are likely to increase. There are projections that more people are going to fall below the poverty line by end of 2020, even into 2021. So if the consumer is struggling, companies definitely are going to struggle because of the weak consumer demand. And these are the micro units of the economy. The micro units are constrained. Definitely the macroeconomic performance of the country too will be affected negatively.
Thank you for that, Dami. So when we put this all together, what does this mean for interest rate policy?
Yeah, so right now, the CBN, at least so far this year, has prioritized economic recovery above its price stability mandate. And right now, we get to a point where the further cuts in interest rates would have little or no impact on the level of liquidity or growth in money supply in the system, which is what we economists call liquidity trap. So right now, even Nigeria is in a liquidity trap. So what we expect to see is that as we enter 2021, and as the economy recovers, both globally and even the domestic economy, we're going to see the CBN revert back to its price stability objective. And down the line, we're going to see a gradual increase in interest rates, because you can't reduce interest rates further than what they are right now, because it's going to have little or no impact. And bear in mind also, you're trying to attract capital flows, so your investment returns have to be attractive. I know that we talked about investment returns being negative. They've been negative since June this year. So we expect to see that the CBN is going to revert back to price stability and make that its primary goal in 2021. And that will most likely see an increase in interest rates. When in 2021, we can't put a figure yet, because that's a function of global recovery, economic recovery. And bear in mind now, we're talking about an increase in COVID cases. So if there is a spike and we have to impose lockdowns or maybe even precision lockdowns, then you know that all bets are off. But most likely in 2021, we're going to see an increase in interest rates. It's going to be gradual, but it most likely will happen.
Interesting. That's going to have ramifications on the stock market as well if rates are going back up. Last question for you, Dami. Back to investment returns for the average Nigerian to beat inflation. Is the answer to seek investments north of 15% or go overseas and seek returns in USD?
Well, right now, in the local domestic economy, it's rare for you to find any asset class that is going to give you returns above the inflation rate. So it's going to be very difficult for you to find that. And right now, it also depends on your portfolio mix. So any investor, the first thing they consider, what is my liquidity appetite? What's my goal for investing? What's my risk appetite? So right now, you're hardly going to find anything that's going to give you rates above that. So obviously, there's always the US investing in USD stocks, but also you have to be monitoring that what is happening in the US economy. We know that obviously the dollar has been experiencing some weakness with everything that's been going on the talks of the US stimulus. But that definitely US stocks is something to look into. But again, it's also a function of your dollar portfolio here in Nigeria. And talking about stocks that you mentioned, there's an inverse relationship between interest rates and equities. You know, towards the end of the year, we saw a rally in the equity market in Nigeria. And also that's a function of the low interest rate environment and the fact that investors were switching to the equities market because really there wasn't that much of an outlet in terms of asset classes. So as interest rates start to increase in 2021, definitely we'll see a shift from equities to more interest-bearing instruments and asset classes such as fixed income. So for instance, the money market instrument rate starts to increase, you definitely see that shift. So it will affect stock market prices.
Fantastic stuff. Head of Research at Financial Derivatives Company Ltd, Damilola Akingbami, thank you so much for giving us your take on what the average Nigerian should do with regard to inflation and what the CBN is expected to do in 2021. Thank you, Dami.